Hi there, Group 29 is here to introduce you to an interesting topic of international financial management, foreign exchange risk.
Hi Ivan, I heard that you're an expert at foreign exchange management. Could you please give me some advice on how to manage foreign exchange risk?
Sure, I'll get you through a short overview. There are three kinds of foreign exchange exposure that companies whose operation involves foreign currencies will encounter. First, transaction exposure. Transaction exposure reflects the sensitivity of realized values, measured in domestic currency and denominated in foreign currency, based on the firm's transaction cash flows. It expresses the unexpected changes in the exchange rate. Second, economic exposure. Economic exposure is referred to as competitive exposure or strategic exposure. It measures the impact of exchange rate fluctuations on the future operating cash flows of a firm. These exchange rate fluctuations affect operating cash flows via sales price, sales volume, and production cost. Third, translation exposure. Translation or accounting exposure demonstrates the effect of changes in exchange rates on the translated, accounting, values in financial statements of the foreign subsidiaries of a multinational. This exposure arises from the conversion of financial statements denominated in foreign currency to statements denominated in home currency and therefore depends on the exchange rate.
I still don't really understand. Can you give examples?
For better understanding these terms, let's have a look at some case studies. We'll see how they implement their hedging. Take this big multinational as an example. A.P. Moller Group is a giant in shipping industry. Headquartered in Denmark, A.P. Moller was founded back to 1904 and became the world's leading product tanker shipping company since January 2009. The group comprises 6 primary business units. Container shipping, APM Terminals Unit which develops and operates container terminals tankers. Offshore oil and gas activities retail activities units which comprises hypermarkets and supermarkets, and shipyards and other industrial unit. Translation exposure is managed within the group using currency forwards and options, and the Danish krone is referred to as the presentation currency. The US dollar is used as the functional currency for 2 units, the container shipping and the oil and gas. For other units the local currencies where the business activities take place are used. The group uses the current rate method of foreign currency translation. Specifically, income statements are translated at average exchange rates and balance sheet items are translated at the exchange rates at the balance sheet dates. All foreign exchange gains and losses are recorded in the income statement as financial income or expense. Next, the management of transaction exposure is simple and straightforward. Based on revenue, approximately 75% of the group's transaction activities use US dollars as their functional currency. Forward contracts are used to partly hedge all net transaction receivables denominated in currencies other than the US dollar. Forward and options contracts are also used to hedge currency risk pertaining to recognized and unrecognized transactions. Finally, economic exposure is managed in an extensive way. First, both internal hedging methods and financial market hedges are used to manage the group's operating activities. Netting is used and prepayment is also used to hedge any foreseeable appreciation of a foreign currency. Also all income and expenses are denominated in the same currency. Second, because the group's net income is in US dollars, financing decisions are also made in US dollars and hence its loans are also in US dollars. The group's financial market hedges mainly involve the use of forwards and options. For future investments in currencies other than the US dollars, both forwards and foreign exchange options are used.
I still not really understand.
How can I explain it better?
Can I try to give you example as well?
Sure.
There is a multinational pharmaceutical company. It operates and generates revenue from both developed markets and emerging markets. As a result, Pfizer is exposed to a variety of specific risks, which are geographic risk, foreign exchange risk, legal risk and integrated risk for M&A. However, the foreign exchange risk is considered as the most significant risk which Pfizer have to face. Pfizer is subject to the foreign exchange risk in not only commercial operations side but also in financial assets and liabilities. Specifically, on the commercial side, over 50% of the group's revenue is from non-US market. There are two ways of FX risk management that the company seeks to implement, which is internal hedging and external hedging. The first method of internal hedging is matching of currency cash flows. Under this way, Pfizer matches its revenue to its cost and its assets to its liabilities, which are under same currency. Also, Pfizer restructures its R&D department to maintain its product pipeline will remain full and balanced. It allowed the company to gain its competitive position compared to its main rivals in the market. Pfizer is selling in multiple markets ranging from developed countries to developing countries. Implementing this strategy would help the group take an advantage of economies of scale as well as diversification of exchange rate risk. Regarding external hedging, the multinational company tends to turn to the financial market, where it provides a variety of derivative securities to hedge the residual FX risk, which cannot be eliminated by operational technique. In the case of Pfizer, managers use FX forward contracts and foreign currency swaps as their external hedging methods. As the result, Pfizer's foreign currency swaps in a receivable position soared to $871 million in 2013 from $194 million in 2012, while FX swap liabilities fell from $428 million to $110 million. However, its forward contracts only showed smaller changes in value. Overall, Pfizer used mostly currency swaps since the manager can tailor the swap in terms of value and tenor of those contracts with a low cost. Pfizer's managers designed foreign exchange contracts to hedge a portion of its forecasted currency: euro, Japanese yen, Chinese renminbi, UK pound, Canadian dollar, and Australian dollar, which denominated intercompany inventory sales expected to occur no more than 2 years from the date of each hedge.
Okay. Now I understand.
But there are still some considerations regarding those hedging methods.
There is a consistency in current practice of currency risk management among multinational company, which is a combination of internal and external hedging, simultaneously.
While financial hedging is quite costly for the firm, but it is highly effective in respect to hedging against the transaction exposure. However, in the case of hedging the economic exposure, internal hedging is used dominantly among multinational compa.
Thank you for your clear explanation on foreign exchange risk management.
No
You're
worries.
welcome.